Good afternoon, everybody. Welcome back to ibkwebinars.com. I'm delighted to be in session here with Ed Mogler, who is the Executive Director at the OCC. Welcome, Ed. How are you doing today?
Doing very well. Always good to be here. Thanks for having me. Looking forward to today's session.
Very good indeed. And tell us a little bit about what we're going to be talking about. Iron condors, what's all that about, Ed?
Yeah, it's a popular strategy involving selling options. So I'm going to bounce a little bit back and forth in the beginning, talking about buyers versus sellers, and then focus on how the iron condor is put together. And I'd say, Andrew, this is not necessarily going to be the most complex presentation. So if you're newer to the strategy or options, you're going to learn a whole lot today. But even if you know the iron condor, I'll throw in some commentary and insight. Hopefully there'll be something here for everybody today.
Very good. Looking forward to that. It's a live webinar, folks, and we're going to put up a disclaimer from Interactive Brokers. We always do this during the live events just to kind of forewarn you that we could be talking about some risky asset classes and so on. So please take a moment to read that. Also forgot to tell you this is live. There will be a link to the recording of this session a couple of hours after Ed's wrapped up later on today. So do look out for that in your inbox. And they're typically available a couple of hours later, but go to ibkwebinars.com to review this and all events from the OCC and from any of our co-sponsored webinar events. Ed, I think you can go on to the next slide. What else did I want to tell people? Yes, please, questions. Put them into the question panel, and Ed does a great job of filtering those questions throughout, or we'll just simply have a discussion at the end and we'll go over any questions. That said, Ed, I'm going to make you an organizer so that you can see the questions coming in, and don't worry if you can't get to them. We'll discuss. All right, so with that, I'm going to put my camera on mute along with the microphone, and turn it over to Ed Mogler. Welcome back, Ed.
Thanks again for having me. Always a pleasure to be here, and I'm looking forward to this session. The iron condor is a popular strategy we get asked about a lot, so we'll look at the ins and outs of this strategy. Just briefly about myself, I got started in the business back in the late 1990s, went right from graduation to the trading floors in Chicago and New York as a market maker in the open outcry environment for a few of the largest options market making firms in the world. When things moved to the electronic environment, I traded in a proprietary fashion, both say stocks, options, and futures as well for a number of years. But here going on 7 years now with OCC, that's the Options Clearing Corporation, in their investor education department, which is called the Options Industry Council. All we do is education, and really enjoy doing these presentations. Anybody that will listen, individual investors, advisors, money managers, that is our target audience. First, here is our disclaimer. And just briefly more about OIC. We were actually formed as an industry cooperative between firms and exchanges in 1992, almost 30 years ago now, as a free resource for options education. That's where you can find us, and you can contact our investor education team. I manage these guys, former traders and brokers. There is the email address, options@theocc.com. If you have questions about events that we've got upcoming or options related questions, we're not licensed to give advice or guidance. We're not brokers. We don't sell data, but we can help you understand some options related topics from an educational perspective. Here's the outline for today. And as I said, it's not going to be too complex. When I sort of categorize my presentations, this is not one that I put in the advanced category, but there is plenty to talk about within these topics. I'll start with an overview of really spreads in general and vertical spreads overall, and then we will narrow that down into the two types of verticals that are known as the credit spreads, and then put together the iron condor. And while I discuss the iron condor at the end, the final segment here, I'll also get into variations and considerations of the iron condor, different ways you could put that strategy together. We'll talk about implied volatility skew. I always like to inject volatility into any options presentation that I give. And when it comes to those variations, I always like to do that because when you're trading in a real account with live money, it's often the case that an investor will take their foundational knowledge of a strategy, its classic definition, and then change it in some way, do something a little bit different, tailor it, tweak it so that it fits their market outlook a little better, their risk tolerance, their objectives looks a little bit better. but it might not fit that classic definition of the strategy. It happens a lot, so we'll take a look at a few of those variations at the end. First, let's get on the same page with what a spread involves, and believe it or not, with respect to spread and even some other options topics, you can have different definitions and different understandings for what a spread actually is in the options space. I've heard some market professionals say that an options spread involves at least two options. You're buying or selling one, you're buying or selling another. Now, I learned that a spread could be one option versus a stock position. Think about covered calls and protective puts, for example, stock versus an option. I consider that a spread as well. But regarding options, we're focused on two different options here today: buy or sell one, buy or sell another. Undoubtedly, you're looking at the same underlying stock. That might not be the case for some people, like to say pairs trade, one stock versus another. But most investors are trading two options on the same stock. Most spreads are the same expiration dates. There's some exceptions there. The calendar spreads and diagonals would be different. Expirations, strike prices, similarly, most strategies are varying strike prices. Something like the straddle would be an exception to that, but different strike prices and quantities. This is where it gets interesting, where certainly there are some strategies where quantities might be defined as being different ratio spreads, 1/2s, 2/3s, and such. But when it comes to those variations of strategies and you start varying quantities amongst the pieces, that's where the flexibility of the option product really starts to showcase itself. And utilizing options in your portfolio is something you can do different things with that you just can't do if you're not using options. Your portfolio has so much more opportunity to put together positions when you're involving options versus those who do not. For today's presentation, we are going to focus on vertical spreads. That's where we're going to start with a broad overview of vertical spreads. This term vertical more or less means that you are looking, say, up and down vertically across the different strike prices within the same expiration date. Of course, the same underlying, same expiration, different strike prices, buying one of the options and selling another. Both of these would either be calls or both of them would be puts. Not mixing and matching calls and puts here. The vertical spreads involve both calls or both puts. Now, there's four types of vertical spreads. You have debit and you have credit spreads, and there's two of each. So I'm going to spend just a minute here dissecting these two. For debit spreads, this of course means you're paying a cash debit. A call debit spread means you're buying the lower strike, more expensive call option and selling the higher strike, less expensive call option. For those of you who like the Greeks and like to put things in terms of Greeks, you're a net buyer of calls in this case. You're buying the more expensive lower strike call. You are long delta if you are buying a call debit spread. And I want to make sure we understand long and short. The option space can be a little bit different. There are two definitions for long and short. When we're speaking about options, most people think long and short as directional bias, bullish or bearish on where the market is going. Well, in options, there's another definition. You can either be long the option or short the option, meaning you either bought it or sold it. So buyers or holders of options contracts are long the contract. Sellers or writers of options are short the contract. Has nothing to do with market direction, just long or short the option. Separate from that, you have long or short that's attached to delta. And that is a directional bias. A long delta position has a bullish bias, and a short delta position has a bearish bias. So long calls, long debit spread is a long delta position involving a cash debit. The long put debit spread involves a cash outlay, buying a higher strike, more expensive put option, selling a lower strike, less expensive put option, getting net short deltas, bearish on the puts. And remember this because I'm going to tie these together. long delta on the calls, short delta on the puts. We look at the credit spreads. If we are now receiving cash, we're getting paid, we're choosing two different call options. If we're getting paid, that means we're selling the lower strike, more expensive call. We're buying the higher strike, less expensive call option. We're net short call options. And if you're short calls, you are short delta. So short delta calls with this credit spread corresponds with short delta on puts for the debit side. So I'm going to tie these together for the time being. And then to finish this up, the put credit spread involves selling a higher strike, more expensive put option, buying the lower strike, less expensive put option. You're a net seller of puts. Selling puts is long delta. So long delta on the put side, the debit version here, long delta on the call side. So these two are tied together, long delta here and short delta on the other side. So what's the difference? Why would one person do a debit spread and another person do a credit spread? If puts are short delta, calls are short delta, what's the difference? Why would you choose one versus the other? And this ultimately comes down to, I would say, the classic difference between just buyers and sellers of options. Buyers are being more aggressive. They have a directional opinion and they are more confident that that opinion is going to come to fruition. Buyers know that they are going to suffer from time decay and the natural erosion of option premium, but they're confident that the stock movement in their favor is going to overcome that. So they want to spend less to make more. Their rate of return could be very healthy. They can make very strong rates of return on their trade if they're correct on the stock moving in the direction they expect it to. So spending less to make more, but knowing they have to be right in order to be profitable. Credit spreads, on the other hand, sellers of options are trying to take advantage of that natural erosion, that natural time decay that options have, and want to give themselves an advantage. Generally speaking, sellers are willing to profit less and risk more in exchange for, let's say, a more favorable break-even point. You'll hear me say that a few times today. A better chance at being successful on the trade. When we walk through our examples, you'll see what I mean by this. But getting the break-even point in a positive position, increasing your likelihood of profitability, even giving yourself the buffer zone to be wrong on your market direction and still having the ability to be profitable. For all of those advantages, you're willing to accept a lower potential return for a greater amount of risk. So now let's focus on the credit spreads, because that's what we're here to do today. Look at the credit spreads and the selling of options, starting with the call credit spread and our motivation. For the call credit spread, remember this was short delta, so that's bearish, but we also have this neutral aspect. Neutral and or bearish will be profitable and will work out in our favor. If this was a debit spread, those of you who remember what I said, call credit spread, what's the debit spread? Counterpart, that's buying a put debit spread and paying for puts. If you were to do that, this neutral aspect would not be here. You would have to have the bearish move in your favor to be profitable. The credit spread on the call side has this element of neutrality where the stock doesn't have to go anywhere and you can still be profitable. One of the main reasons why vertical spreads are popular for options investors is this element of defined risk reward, controlling your risk, calculating the profit potential, the maximum potential loss, having this favorable break-even point that we're going to see here when we get to the example in just a second, and really having those risk controls in place where you can calculate those numbers and find a level of comfort in knowing exactly how much you stand to gain and exactly how much you could lose, and maximizing both of those numbers. I'll just add one more element to this, that element of risk control and defined maximum loss is there and is true while the options exist. You gotta be a little bit careful when it comes to position monitoring and watching the potential for exercise and assignment activity, because if the options position becomes a stock position, then this element of defined maximum loss is changed greatly. And a stock position would look far different than what the options piece would. And we'll talk about that as well as I walk through different scenarios here. But here's our example. Stock's at 88.5 with about a month left until expiration. And for whatever reason, you believe the stock might be sort of consolidating around this 88.5 level. Maybe it's going to go lower. So you have that neutral to bearish, certainly not bullish outlook on the share price. There's a number of different things you can do here, of course, but we'll start with this call credit spread being your decision, selling the 1 month 90 strike call for $3.50, and then protecting the risk of that position by buying a 95 strike call for $1.80 and getting a net credit between the two options of $1.70, likely entering both of these at the same time. Sell to open, buy to open for one net price of $1.70, executing both sides simultaneously, and then having a spread in place. Now let's talk about strike selection. Generally speaking, when you are selecting your short strike, it's the stock level that you believe the share price might actually get to, but you don't believe it's going to break through that level. So 88.5 is where we're at. We're thinking maybe we get to 90. I could see the stock maybe getting up to 90, but it's really not going through that 90 level. That becomes your short strike. If you didn't think it was going above 89, if that was strong resistance, you'd select 89. So this is the stock price that you think shares might get there, but they're not going through that level. And there's your short strike. Now, once you have that determined, the buy side of your credit vertical is really about risk management, risk control. This is just there for protection. If you wanted to be, say, more aggressive with this trade, if you were more confident that the stock was going to stay below 90, then you might choose the 100 strike call to protect this position. That would cost you less. You get a greater credit. Potential reward is greater. Potential loss is also going to be much greater, but that would be more aggressive, going higher in strike. In our example here, we look up and down the chain. You can look at the 100 strike, the 97s, the 95s, and 92s. Incorporate your level of confidence. Look at the premiums. Look at what that means for risk reward. Make your decision. In our example, we'll use the 95 strike. So here we have our spreads. So short the 90-95 call credit spread for $1.70. And I want to look at maximum gain, maximum risk, and break even. So I'm just going to pause here for a second before I show those up. Think about it for a second, jot the numbers down, think about them in your mind. What is the maximum gain of this spread? What's the maximum risk? And what is the break even point? Just give you a few seconds there, and then I'll put the numbers up. So we'll start with max gain. Just like anytime we sell options, the most we can make is the credit received. The value of these options can only go down to 0, not below that. So our maximum gain is going to be the amount we received in credit. That's $1.70. Maximum risk is $3.30. What's the worst that can happen here? And that's if the stock rallies, it threatens our spread and goes all the way through that 95 level. At 95 or above, then both of these options are subject to exercise and assignment. Remember what it means to be short the calls at the 90 level. We have to sell stock there. Long the calls at 95 level, we have the right to buy shares back. If that were to occur, selling at 90, buying at 95, we're giving $5 back to the market. Giving $5 back after having received $1.70 up front, that's ours to keep, means our maximum risk, $3.30. I have margin here, just so you have it in your mind. If margin is a consideration of yours, you will have some level of margin requirement. It could be equal to your maximum loss. It could be actually higher than this, considering the short option element and the possibility of short stock resulting from that. You could have a higher margin. Just here to make sure you don't forget about the possibility of margin. and break-even point 91.70. I'll define this a little more clearly on the next slide. But here's a common question that investors ask: what's this spread worth if the stock doesn't move in 3 weeks or in a week, or if it does, if it goes to 89 or 87 or 85? What is this spread going to be worth? And you really can't. It's an imprecise calculation to try and determine what an option or a spread might be worth given a date in the future. And I'm just going to go ahead right now. When we draw these P&L graphs, we're going to see a lot of them today. Stock price here along the horizontal axis and profit and loss here along the vertical. You're going to see a lot of them. All of these are drawn with the assumption that we've reached expiration, because at expiration, there's no more time left. There's no more element of uncertain volatility levels. We can select a stock price and calculate exactly what the option is worth given that stock price at expiration, because options are only worth their intrinsic value at expiration. So these graphs are always drawn with the expectation that we're at expiration. If you want to forecast what a spread might be worth given certain variables in the future, you can still do that. You can use a calculator. You can enter in whatever stock price you think you want to investigate, change the days of expiration. You will need to insert an implied volatility assumption. You can extract that from today's market possibly, or forecast something out on your own. You will need to input something there as an implied volatility assumption and then calculate a theoretical or hypothetical, I will emphasize, value for what the spread could be worth in the future, pending possible changes in implied volatility levels. And implied volatility changing, that is simply changes in buyers versus sellers, supply versus demand. That's all it is. When the implied vol goes up, there's nothing mysterious going on. That means there's more buyers coming in and options prices are going higher. Therefore, implied vol is going up. When implied vol goes down, that just means more sellers are coming into the market. Prices are getting depressed and implied vol is following and moving lower. So that's how you can forecast prices in the future. But we're going to look at P&L graphs, assuming we're at expiration, back to our spread, short the 90-95 call spread, net credit of $1.70. Break-even point would be the stock price at expiration, where we give back the net credit we received up front. We are obligated to sell stock at 90. So if shares at expiration are $1.70 above that level, we're at 91.70, that becomes our break-even point at expiration. I have a few things here to say about the stock being in between the strikes at expiration, because this is where position management and monitoring becomes paramount. But before I get there, I do want to talk about that phrase I used earlier, favorable break-even point. What do I mean by that? Remember, the stock here is at 88.5. We're under 90 in the share price right now, 88.5. And look where this break-even point is. It's $3.20 above that. I used to be better at math, so that's about 4% or so, a little less than 4% above where the stock currently is. So if the stock consolidates right here around 88, we reach max gain. If the stock sells off, max gain. Even if the stock were to rally $1.50, we still have our max gain. We could be wrong by over $1.50 and still be profitable all the way up to this 91.70 level, and then we start to experience losses. That's what I mean by favorable break-even point. And you can see why we're getting a favorable break-even point is the max profit is $1.70, the max loss is $3.30. So we have a much greater potential loss than potential gain because we are getting that advantage of time decay, of natural erosion, and this break-even point that is on the positive side or the better side of where the stock is. We can be right, we can even be wrong by a little bit on where the stock is going and still be profitable. That's that element of favorable break-even that is consistent when you are selling options, giving up that risk profile, profit versus loss. Now, if this was a debit spread, by the way, the break-even point would be on the other side of the stock. you would have to have the move. The move would have to be lower in order for you to be profitable. Otherwise, you would lose. And in exchange for that, the debit spread buyer would have their max profit greater than their max loss. Again, key difference between buyers and sellers. At expiration, stocks below 90 a share, then we would expect both options to expire worthless. This is what we want. We keep our $1.70 net credit, and that becomes profit. There is assignment risk if the stock is close to 90. Always want to emphasize that when we're sellers of options, the choice of being assigned is out of our control. Option buyers have paid for the right to exercise, whether it's in their financial best interest or not. They can choose to exercise and buy shares at 90 because they paid for that right, particularly if the stock's close to 90. If we're watching expiration Friday, stock's trading $89, it's going into the closing bell, it's ticking higher, 89.5, 89.70, 89.80. We hit the closing bell, we're short the 90 call. We're not safe from assignment. We don't know if we're going to be assigned or not just because the stock closed 20 cents below the strike. If the option holder, the 90 strike holder, is watching after hours activity and they see that stock ticking up to 90 and above, they can let their firm know. They can proactively say, I want to exercise this call option even though I know it expired out of the money based on strike price versus closing price of the shares. They can still exercise. As the option seller, we have to be aware of that. That's called pin risk. When we're short an option and the stock is very close to the strike, we don't know for sure if we're going to get assigned or not. If assignment is something we can't tolerate, the only thing you can do is buy back to close the 90 strike. The only way to avoid assignment is to not have an assignable position. Buying back the 90 strike to close is the way to do that. Not always easy to make that decision. Believe me, I've been there. We all want to squeeze every penny out of every trade we get. And if you feel like you don't have to pay a nickel or a dime to buy an option back, you might not want to, but just understand that risk is there. If the stock's close, you do have that pin risk and could potentially be assigned. Stocks above 95 at expiration, we would expect both options to undergo exercise and assignment activity. Selling shares at 90, we're short the 90 call, selling shares at 90, and then having the right to buy them back by exercising our 95s. This is giving back that $5 and having maximum loss of $3.30. If the stock's close to 95, we really don't have pin risk. That doesn't exist for option holders because we're in control. The stock's trading right around, back and forth around 95 at expiration. Say it just barely gets above 95 or so. We are in control. We have the choice. We can, if we want to, proactively communicate exercise instructions to our broker just to make sure the 95 call option gets exercised to protect the risk against the assumed assignment on the 90 call. So we're in control when we're long an option and the stock is very close. That's different from being short. So no pin risk when we're long. And then here's a little further discussion. With the stock in between the strikes, we already said the break-even point's 91.90, so profitability will be determined on where exactly is the share price in between those two levels. But here we now know that we can expect the 90 calls to be assigned. That would leave us with a short stock position. We're not going to want to exercise the 95s. If the stock's trading 93, 92, 91, we're not going to want to pay 95. So this is where position management and monitoring is paramount. Most investors I speak to don't want a short stock position. They're not interested in having that in their account. They might not even have approval for that in their account. So if you find yourself in this position, then you will want to make note of that and proactively do something, which is, again, closing out that short assignable position to avoid any risk of being short stock. Now, you could try to close out the spread, but if you're on expiration and the stock's down here 93, 92, 95 calls probably trading for nothing. So you're probably left looking at the 90 strike, seeing what its bid ask is, and possibly trying to get the best price you can to get out of that short assignable position and avoid the short stock position. By the way, I'm talking about closing options, not dealing with exercise and assignment. That's what most options investors do. 70% of all options that are opened are closed before ever reaching expiration, before ever dealing with exercise and assignment. They don't expire worthless, they're closed. 70% are closed before ever reaching expiration. About 10% of all options that are opened are exercised at some point, and about 20% of all options that are opened are held through expiration and expire worthless. That's the way the numbers break down consistently over the years. So closing out the positions, either for profit, for loss, to avoid an unwanted stock position, very common, and that's what most options investors are indeed doing. Let's shift gears into the put credit spread, and I'm going to walk through this one a little quicker because it's going to look very similar to what I did for the calls, just from the opposite side. There's a few, at least one key difference I'm going to walk through, but a lot of this is going to look similar. So my motivation for the put credit spread, remember I said this is long delta, selling at puts, being a net seller of puts is long delta. So that's consistent with bullish. And because we are doing a credit spread and we're a seller of options here, we also have this element of neutrality. We can be profitable in a neutral environment as well. So neutral and or bullish on the underlying. Everything else here looks exactly like it did before with the call credit spread, defined risk reward. We'll see that element of favorable break-even point once again, and defined, calculated maximum potential profits, maximum potential loss. Again, that is while the options trade is open. This changes if we end up with a stock position, but while we have the options, we can precisely calculate that profit and loss potential. I'm going to keep the same stock price, 88.5. I'm going to see that again later. For consistency, 88.5, 28 days to expiration, we're neutral to bullish, and we decide that we're going to sell a put spread. Looking at the 85 strike and selling that for $2.05, protecting that risk, buying the 80 strike put for 70 cents, and we have our net credit of $1.35. Again, probably entering this as one trade at one net credit amount of $1.35, executing both sides simultaneously. Selecting strikes, very similar, just as what I said before with the calls. You were looking for that level you think the stock might get up to. You reasonably think it might get up there, but not through that level. There's your call strike. Here on the puts, same discussion. How far do you think the stock might drop down? Maybe it pulls back a little more. Select that level that you think the stock might get down to, but it's not breaking through that level to the downside. And here we'll say that price is 85, and that becomes the call put strike that we sell. The strike on the buy side is all about risk protection, risk management. How far down do we want to go? We can price this up. Look at the 82s, the 80s, the 75s. How much is that going to cost? What is the credit at those various strike prices? What does that mean for maximum gain, maximum loss? And then you also, of course, would incorporate your confidence level. If you're more confident that the stock is going to stay at or above 85, then you can be more aggressive on this trade. Then you don't have to buy as much protection. You can look down lower, 78 strike, 75 strike, and pay less, accepting more risk. So you have to find that sweet spot for you based on your confidence level in the market outlook that you have and the premium this is going to cost you to protect the position. Same as I did before, we have the 85-80 put spread, sold it for $1.35. Max gain, max risk, break-even point. What are those three numbers? Max gain, max risk, break-even point. Think about it for a few seconds, and then I'll throw the answers up on the screen. Start where I did before. The first answer should be easy, as I talked through it last time. When we sell options, the most we can make is the credit received here at $1.35. That's going to be our max gain. We calculate max risk the same way as we did before. What's the worst that can happen? The stock runs lower to 80 or below that level. If that were to happen and both put options are in the money, subject to exercise and assignment, we're short the 85 put, obligated to buy stock there. We're long the 80 put, We have the right to sell stock there. If that happens, we're giving back $5 to the market. We received a credit up front, that's ours to keep. So maximum risk, 365. Then I'll talk through break even right here. At what stock price at expiration would our position give back $1.35, the credit we got up front? Again, that's ours to keep. What stock price at expiration do we give that back? And that's when our obligation to buy stock is $1.35 above the current stock level. And there you go, 83.65 is your break even. Same thing with respect to what might this spread be worth if the stock's at various levels. You can change the stock price, change days to expiration, use a calculator to forecast and estimate what it might be worth in the future. Our P&L graph at expiration, you can see our max gain, max loss. Again, with respect to that favorable break even, stock's at 88.5. And we went out a month and we sold this put spread, and look at profitability all the way down to 83.65. We're neutral to bullish on the stock. And this stock can rally, it can consolidate, or it can sell off all the way down to 85. That's $3.50. And we still reach maximum gain. It can continue to sell off down to 83.65. And we reach break even. That's that favorable break even aspect involved with selling options. In exchange for that and that greater likelihood of being successful, max profit, much less than our maximum potential loss. For the debit version of the put credit spread, that's the call debit spread, the long delta call debit spread. If we were using out of the money options here, then we would be on the other side. Break even would be on the other side of the stock needing that bullish move in order to be profitable. At expiration above 85, we have both options expiring worthless. This is what we want to happen. We reach maximum gain with the stock above this level. No exercise and assignment activity, max profit $1.35. We have that same pin risk, assignment risk. If the stock is close to 85, we are uncertain about being assigned on the 85 put. We don't know if we're going to be assigned or not. If the stock closes at the closing bell at 84.90 or 85.10, we really don't know what the option holder is going to want to do. That's uncertainty. That's pin risk. We can look at after hours activity, but once we're in after hours, we can't manage the position anymore. So we can only watch after hours to maybe get a better idea of what the option holder might decide to do. But we're going to manage this position. We can't wait that long. And if you don't want to tolerate assignment and the stock's right around there at 85, then you have to close this out and remove the open short assignable position. Below 80 at expiration, this is what we didn't want to have happen, but we do take comfort again with these vertical spreads. We know exactly what we stand to lose. We got comfortable with that at the outset. And also we were just completely wrong. We thought the stock was going to consolidate or move higher. Not only did that not happen, this stock got clobbered and went all the way down below 80. If we were that wrong on our market opinion, okay, yes, we did suffer some losses here, subject to exercise and assignment activity. To buy shares at 80, that's our obligation. We have the right to sell them. Buy shares at 85. So we have the right to sell them at 80. That's giving $5 back to the market. We received $1.35 up front to keep, and there's $3.65 maximum potential loss. In between the strikes, this is a little bit different than the calls. So here we're in between 85 and 80. Break-even point was at 83.65. The profitability determined from there. I was talking about the call spread. You know, I had mentioned most investors are not interested in being short stock. They don't want to be assigned, and it's imperative that they close out that short position to avoid it. It might be a little different on the put side. It is possible that the put seller reevaluates their market outlook, their opinion. If the stock did drift all the way down to say, 81, 82, and now you've noticed it's found strong support and it's starting to bounce 82, 83, 84, and you think this stock's about to run and take off, and all of a sudden you're aggressively bullish and you're comfortable committing capital to buying shares and having a long stock position, that becomes a feasible choice here on the put side. It's the difference between being short the calls and short the puts is being assigned on puts means long stock, and that's something investors could consider. They could change their mind and treat this short 85 put more or less as cash secured. Come up with the capital, accept assignment, and take a long stock position. Just word of caution with that, just if you do consider that type of thing when you are subject to assignment on puts, make sure that you're being honest with yourself and that accepting assignment on that short put is the result of your true change in market outlook on the share price, and it's not just because you don't want to take a loss on the trade and you want this trade to come back to break even just so you can see a green number. And again, I've been in the markets for a long time, and I have countless numbers of examples, particularly newer in my trading career, where I was making bad decisions and I was convincing myself of things just because that hardest trade to make is to get out of a losing trade. So just keep that in mind. There's different psychological tactics you can try and use to try and avoid that. One of them, I'll just give you one example that I taught myself early on to discipline myself out of bad trades, was to always think of alternatives, always look for other ways to make that money back. And when you're suffering a loss on a trade, you want to make that money back, but this stock, this position might not be the best way to do that. What you're most interested is in making those dollars back and turning those dollars positive. Whether you make it in ticker A versus ticker B really doesn't matter. So always be looking for those alternatives and other possibilities, and then ask yourself, yeah, I want to make this money back. I'm losing, but maybe I have a better opportunity to make it back over here in this other trade. That was one of the things that I did that helped with the discipline of closing out losers that weren't going well and moving them into better positions, thinking about it more in terms of dollars. I want to make dollars back. I don't really care what ticker symbol I make it back in, and consider those alternatives. It's one way to help with the discipline. So there's a lot there on call credit, put credit, spreads, and now we're going to look at this iron condor. Popular strategy, of course, involves selling options. That's what we're here to talk about today, and we add some complexity here, but if you followed everything there, if you're familiar with the iron condor, it's really not too bad. And then when we look at the P&L graph, I'll talk about some variations on which. Now, as we had said previously with the two vertical spreads, there's an element of neutrality in your motivation, but also a directional bias. It's a neutral or bullish, neutral or bearish. Well, here with the iron condor, that directional element is gone. You are truly neutral on the stock. You believe it's range bound in between two levels, and you're going to attempt to benefit from the stock not breaking above a certain level and also not breaking below a certain level within a certain period of time. And that motivation might lead you to use this iron condor strategy. It's as simple as putting together the two spreads that we just talked about, the sale of a call credit spread, and reminding you what that P&L graph looks like, and the sale of a put credit spread, P&L graph down here. Same stock, same expiration month, both spreads using out of the money options. Now, this is going to be four pieces. There's four sides to this. You're selling a call, buying a call, selling a put, buying a put. Most of the time, or I should say the classic way to initiate an iron condor, is to have all four of those pieces executed at once. And you likely can do that. You might do that manually, putting in all the options yourself, or maybe select strategies in your order entry that actually says iron condor, and you can maybe enter a little more simply that way. All four pieces at once, sell to open, buy to open. You're doing that a few times, and having one singular net credit price to execute all four pieces at once. That's the way an iron condor would be executed. You don't have to do them all at once. I'll talk a little bit more about legging into the spread in just a minute. Here's our example on the iron condor. Same stock price as before. I'm going to use the same spreads as we did before just to illustrate how this is put together. So 88.5 is our stock price. The expected range now is 85 to 90. So we don't have a neutral to bullish or neutral to bearish outlook. We have a true range bound expectation, a neutral expectation in the share price, in between 85, in between 90, So we now implement both vertical credit spreads, selling both of them for a total net credit of $3.05. Now this is typical. I'm saying the word typical here because you have the width of the strikes being the same, $5, and you have the short strikes, the 90 short call, the 85 short put, being somewhat centered around the stock price. Not exactly, but more or less centered around the stock price is where your short strikes are, and then going equidistant out to buy your protection. That's typical, that's classic iron condor, but again, we'll look at some variations here in just a second. Last quiz of the day, same type of quiz here. We have this call credit spread and put credit spread put on together to form the iron condor. 305 is our net credit. Maximum gain, maximum loss, break even. Take a second to think about those three, and I'll put the numbers up in just a few seconds. Start the way we did before with selling any spread. And here we're selling options for a total net credit of 305. The best that can happen is all the options expire out of the money and worthless, and our maximum gain is 305. Most we can make is the credit receipt. There's max gain 305. Max risk, a little different here. We have two short vertical spreads on either side of the stock. We know the stock price can't be in two places at once. It can either threaten the call side or threaten the put side, but it can't be above 95 and below 80 at the same time. So one or the other might finish completely in the money. That's the worst case scenario here. So if either one of these spreads was $5 in the money, then we would potentially be giving back $5 to the market. And with our net credit being 305, that puts the max risk of this trade at $1.95. See how we flipped the max gain, max risk in our favor now? This is a very popular reason why the iron condor is a widely used strategy. Max gain likely, depending on strike prices, likely greater than your maximum risk. And the reason why we're getting that advantage is we're now taking a risk on both sides of the market, a big move in either direction, and we're going to suffer. Break-even point, let's take a look at break-even and calculate that. We have our spread 90, 95, 85, 80, total net credit of $3.05. We've got potential risk on both sides, so we're going to have two break-even points. At what stock prices at expiration do we give back $3.05? We have obligations at these two interior strikes to sell stock at 90. Our break-even point would be when we give back 305, $3.05 above that, and we're obligated to buy stock here at 85, so break even is going to be $3.05 below that. And another thing you'll see here with the iron condor is a really nice wide range of profitability. Between roughly 82 and 93, we are profitable, and that can look very healthy. Considering maximum gain of 305 as a $5 range, and that is currently around where the stock is currently trading. But we do take risk in either direction. So more favorable risk reward, really nice break-even points, nicely spread apart, but risk in either direction. So good strategy, fun to use. A lot of investors use it, but I sometimes get asked the question, do iron condors work? Well, they work as advertised. They work as advertised. They are going to capitalize on time decay. They're going to capitalize on natural erosion of premium. They're going to have a nice looking risk reward profile, break even points. But if the stock makes a big move, doesn't matter which way it goes, you suffer, and you suffer losses there. So now variations, I'll spend a few minutes on variations, then we'll take a few questions. Different ways you could put this together. One way is legging into it. I mentioned it before. You don't have to put all four pieces on at the same time. If you think the range is 85 to 90, but the stock is at 90 right now, and you think it's actually going to pull back, then temporarily you are neutral to bearish. You can execute the call credit spread, but forget about the puts for now. And then when the stock drifts lower, it doesn't have to come all the way down to 85, but it starts to drift lower, then the put spread is going to start increasing in value, and you can then leg into the iron condor by selling the put spread at a later date. You can obviously do it in the other direction. You can also be more aggressive if you feel like a stock is bouncing in between levels and it's going to keep doing that over and over again. If you execute the call spread first, stock drops down to 85, and then you execute the put spread, now you've got an iron condor. You can take a peek and see what's that call spread trading for. Maybe I'll buy it back because I think now the stock's going to bounce and somewhat open and close either side of the verticals within the iron condor. Back and forth. That might be difficult to execute, but that's something to keep in mind, maybe as an ideal situation that you can try to execute occasionally, at least once or twice. You can also distort the quantities here. Now, I'll caution you, you can certainly sell more of the put options than the put options you buy. You wouldn't want to do that with the calls, but you can think about selling more put options. I'm going to draw in the volatility skew. I said I was going to talk about that a bit here today. Going to draw an implied volatility on the vertical axis, and K here is going to be strike price with at the money roughly right there. And let me just draw in the classic shape of a volatility skew across strike prices. And what this is, for those of you who aren't too familiar with it, we have strike prices and we have implied volatility plotted across strikes. And traditionally, the most classic looking volatility skew looks like this because put options tend to have higher prices, actual higher option premium amounts relative to their call counterparts. That's because of the protective nature of puts. They're used to mitigate risk. So calls and puts could be used to speculate, but there's that added demand. There's more buyers for puts, generally speaking, because they have that risk protection element. Higher prices for options means higher implied volatility levels. This is a classic looking volatility skew. I'll emphasize that there's no rule that stocks have to have this kind of volatility skew. You can have symmetrical skews and inverted skews. Of course, you want to check this out. But if we go with our example, and this stock within our example has the classic volatility skew, think about where the strike prices are. Our call strikes are up here, our put strikes are here. Which of these four options has the highest implied volatility? It's going to be the 80 strike, the lowest one. And are we buying or selling that option? Well, we're buying it. We're selling the 85, we're selling the 90, we're buying the 95, buying the 80 put. So if you're a volatility trader, if you're concerned about volatility, you don't like buying options at high vol levels, you might not like this aspect of buying the 80 put amongst the four options. This is the one that some options traders would say that's the most expensive. And they simply just mean it's the highest implied vol level when they say most expensive. You might not like that aspect to this strategy. So one possibility here, so leave this off. You could sell the put, sell the call, buy the call, and have a three legs instead of four. That's not an iron condor. It's a variation of the iron condor. You know what the iron condor is. You know what its classic definition is, but you just don't want that 80 put in there, possibly because of the implied vol level. So you can consider that, or if you're trading multiple quantities, you're selling 5, or say you're selling 10 iron condors, you can think, well, maybe I'll just buy 5 of these puts, spend less money, and treat 5 of my short put options as uncovered or cash secured. And I'll go ahead and take the stock position or manage my way out of that position should those naked put options get threatened. Now, with respect to the call side, certainly it's a different story. Being short more calls than you're long is a bit different here. You don't have that element of volatility to be too concerned about. And then, of course, being short more calls means you have uncovered naked calls. And that element of risk is just a bit different. You can also stagger strike prices. A couple more variations. I don't want to take too long on this, but stagger strike prices. If you feel more confident in one side or the other, say you have this range that you're expecting, but you're really more confident that the stock's not going above 90. Maybe it does drop, but really don't think it's going higher. You can stagger this. You can sell more call spreads than put spreads. Sell 10 of these, sell 5 of these because you have more confidence over here. You can break the strikes on the call side. Again, if you're more confident the stock's not going higher, Maybe the 95 is just going to cost too much. So you sell the 85 put, buy the 80 put, sell the 90 call, and buy the 100 call. Right? It's sort of a broken wing, broken strike iron condor. Remember what that does for you, or sort of what works against you there is you'll now have maximum risk increased on one side of the condor versus the other. But you can break it up that way and do different things. So there's a lot of different variations here. I didn't even talk about position management, but there's a lot of different ways you can implement this strategy, different ways you can do it that really showcase the flexibility of the product. So I think I've rambled on for enough on the iron condor. I apologize for not leaving more time for Q&A, but Andrew, if you're there, let's try and knock out a few questions before we wrap it up today.
Thanks, Ed. Really, really clear. Couple of questions. Bashar asks about the implied volatility. I thought you explained that really, really well. Basically, what you're saying is that for the underlying price, when the underlying price remains the same, but the price of a call option or a put option increases, there's only one reason it can happen. That's because market makers or the market in general is assigning a higher implied volatility, right?
Yeah. So again, good point to say if the stock remains unchanged, and that's a good all else remain unchanged. If there are more buyers coming in, buy orders coming in, I'll reflect on my time on the trading floor. When there was order flow coming into the trading pit, that was buying options. And I'm a professional. I don't want to sell options all day. So if buy orders keep coming in, I'm raising my options prices. And I'm raising them until I get to a point where there's both buy and sell orders coming in. I want to be neutral. I want to buy and sell all day long, not be on one side of the market. So if buy orders are coming in and I am raising my options prices as a result of that, the only way I can do that is to start ticking implied vol higher. And I'm doing that so I can raise my prices, and I'm doing it as a result of the direction of order flow. So that's what I mean by implied vol moving up and down is really the result of the direction of order flow. If there's more buyers coming into the market for options, driving options prices higher, implied volatility moving up follows that. And it's one of the definitions of implied vol is the implied volatility level that justifies a current options price. Well, if that option price is moving, say, up, you need to move implied vol to justify that new price. And when prices of options are coming down, you need to move vol down to justify that new price. Again, as you said, Andrew, all else equal. So yes, that changes in implied vol really come down to buyers versus sellers.
And again, let's just assume that the underlying price is $85 and that a put option with 30 days and a call option with 30 days are both priced at $1 each. So the straddle there, add both the call and the put price together, is $2. So we're expecting $2 movement either side of the 85 for break even there, right? So the higher the premiums go, it's basically the market is basically saying we're widening out that range of expected outcomes, and
exactly.
That's what volatility buyers or people just wanting to get their hands on options are expecting a move, and so that's higher and higher the premium goes. And when that feeling goes away, people say, well, that range is just too big, and they'll start selling implied volatility through options, and that will get absolutely smaller.
Yeah, I'm glad you mentioned straddle there, because when you hear often economists or in articles, analysts saying that the options market is expecting a 3% or a 5% move after this earnings announcement, they're looking at straddles, and they're looking at the straddle that expires right after an earnings announcement. So your earnings on Thursday, let's say the stock's trading at 100, your earnings on Thursday, and the 100 strike straddle that's expiring on Friday is trading for $5. That's where that number comes from. The options market is expecting a 5% move in the stock as a result of this earnings announcement. Now, if buyers come in to the options market, all of a sudden that straddle's trading for $6, then implied vol is higher, and the options market is now expecting a 6% move as a result of that binary event earnings announcement. I'm glad you brought in straddles there, because you'll hear that a lot around earnings season.
So a more general observation, and I might nip into Trader Workstation to show this, but I've heard of a lot of option traders that they'll talk about you mentioned which strike prices to target, and you also talked about, you know, like if the stock rallies, then best thing is to write that call spread into that strength, and if the share price comes down, then write the put spread into that weakness, right? People talk about standard deviation in terms of where they should be selling or where they're looking to pick the strike to sell options. Do you want to talk about standard deviation as regards the current underlying price and a specific expiration?
Yeah, so you could use sort of your implied volatility level as a way to calculate an expected one standard deviation move in the stock price between today and expiration date. That is a calculation that you could do to try and help yourself determine within some reasonable expected percentage of probability where the stock might remain between those two levels. Now, I could say oftentimes that range is pretty wide, but you can still use that range as a guide or a start. Say, well, here's my starting range of where I really think, based on standard deviation, the stock might stay between. Let me go ahead and look at the option prices there and see what the put and call are trading for. But then often, if you're doing that kind of thing, you end up narrowing those strikes a little bit more. So if you're using that as a strategy over and over again, you'll probably need to take that standard deviation analysis and then haircut it a little bit. I don't know if that's the right word, but in some way sort of chop it in to get more interior strike prices to get favorable premiums. But certainly implied vol levels are used by some traders to do that calculation. One standard deviation move, expected to happen 68% of the time, 2 standard deviations. You can do that calculation using implied vol, just multiplying it by the stock price. That's all you have to do for that one standard deviation move.
Good enough. Nicholas has got a question here. Do you aim for all legs being of equal delta to achieve delta neutrality?
Well, see, that's a good question. So I suppose the answer would be yes in the context upon which I introduced the iron condor. If you are truly neutral from where the stock is right now, then yes, you would want total delta neutrality. Now, as you just asked me about or mentioned before, Andrew, if you felt like the stock was at the high end of the range, one of your choices is to leg into the iron condor, sell the call spread first, maybe wait for a pullback, sell the put spread later. If you didn't want to leg into it, but you felt like, say the stock's trading 89, you think this range is between 85 and 90, well, maybe you would execute the iron condor just to make sure you get it in place, do all 4 pieces, but you'd actually be a little short delta there because you're not choosing your strike prices equidistant from where the stock is. You're actually selecting a call strike pretty close to where the stock is and a put strike a little bit further away. That would not turn out to be delta neutral. You'd be a little short delta there, looking for that stock to drift lower but stay within the range. So within the context of how I explain the strategy with my example, yes, you're more or less looking to be delta neutral, but you are looking mostly to select your strike prices on the short strikes within the range you think the stock's going to stay in between, and if the stock happens to be closer to one or the other strikes, you might have a little delta to deal with, but hopefully that goes away if you're right on your market forecast.
I think something else to note here, Ed, is there is no harm in having kind of wider parameters here, right? So you're talking about a 3 or 5, a relatively large credit. If you were to move this out, instead of being 85, 80, 90, 95, if you move it out to 80, 75, and 95, 100, the credit is far lower, but there's a greater likelihood of landing in that range. So you're really just picking up a smaller overall premium or net credit, right?
Yeah, it's all about risk reward there and your confidence level in that range. You're exactly right. If you move these strikes out on both sides, your range of profitability is going to be much more favorable to you, and then you will have skewed that risk reward in the other direction and most likely have gotten a net credit definitely gotten a net credit far less than 305. So yes, this element that I had defined here of, well, now all of a sudden we have a net credit that's greater than our potential loss, you're right, that's a function of the strike prices we have here. But if we went further out and still did a classic typical iron condor, but at wider strikes, then we wouldn't have this more favorable aspect to it. But here, this is the way it worked out.
Let's see, Rafael asked the question, would volatility skew influence the decision to pick a put or a call spread, long or short, and how?
Well, I think that the direct answer is, if you are looking at volatility and you're concerned about volatility skew, the answer is yes. Now, in the example I gave, we assumed we had a classic volatility skew, and maybe this influences the highest implied vol strike that we're buying on the 80 level, and maybe you start to think about that. But in today's environment especially, there are all kinds of different vol skews. If you look at an equity and you see a symmetrical vol skew, you might be much more comfortable doing equal quantities across the board. Or if you see an inverted vol skew, and Andrew, we're seeing a lot more of this today in today's world with call speculators being in the market more today than I've ever seen before. We're seeing inverted or slightly inverted skews. You might look to take advantage of that and sell more calls. Remember, I said one thing you can do with the iron condor is, if you're trading multiple quantities, there's all sorts of things you can do, but maybe sell more call spreads than put spreads to take advantage of that inverted skew. Or in this case, if you're truly neutral and you're looking to do some quantities here, maybe you do more puts and buy fewer, you sell more puts than you purchase. I mentioned that earlier, again, considering vol. So yes, considering I vol, considering skew, but you'll want to make sure you know what kind of skew you're dealing with on the stock that you're trading, because they can take all sorts of different shapes. I just simplified for my example that we're looking at the classic shape, but you'll want to see what that looks like. And it's not hard to do. Stocks at 88.5, just look at the 80 put. What's it trading for? Look at the equidistant call from there. What's it trading for? Just look at the two numbers and you'll get a sense right away. Are these numbers the same? That's a symmetrical skew. Is the put trading for more? That's classic. Is the call trading for more? That's inverted. It's fairly easy to just eyeball and see what the skew looks like. And you can do, of course, a deeper analysis than just eyeballing it. You can just take a quick eyeball snapshot and see what you're dealing with, and then make a decision from there if you want to buy more or sell more in one spot or the other based on what kind of skew you're dealing with.
And any comments on kind of stock selection here? I'm not looking for recommendations or anything, but I mean, we all have our favorite stocks. We have things that we might be biased towards owning. What about a stock that's in an uptrend? I think I kind of, I guess your starting point here is that we don't see that much more upside, or we're not too worried about it going down.
Yeah, well, I can't talk ticker symbols, but certainly it's all about market outlook and motivation. I think you just mentioned there, something that's in an uptrend, something that's maybe channeling higher, setting higher highs, higher lows. That's not going to be a situation for the iron condor. Certainly, you're looking for something that's more or less trading across within, say, Bollinger Bands that are tightening and they continue to tighten. And you're looking at this thinking they're going to continue to get tighter and tighter. If you're doing, say, a Bollinger Band analysis, or you're looking at support resistance, maybe a new high level that just is not getting broken, but also a support level that's holding. That true neutrality is iron condor. So. Can't really talk tickers, but just make sure, the iron condor, it's a wonderful strategy, but as I said before, works as advertised, not something you're going to want to use if your opinion is trending higher, trending lower, big move might be coming. Don't want to be pulling out the iron condor out of your toolbox then.
And what about the choice of 28 days here, or a 1 month option? Is this specifically because of theta in the last weeks?
It is, yeah, and I'm glad you're bringing this up because I didn't really mention that. When it comes to selling options, we're trying to capture premium, capture time decay. We are going to try and find that sweet spot of the expiration date. Time decay starts to accelerate right around 40 to 45 days. I'm not going to pick a day because I think different instructors have different opinions on that, but right around 40, 45 days, time decay starts to accelerate. And most option sellers are not going to go too far out beyond that 40-day level. You certainly could pick, 6, 7 weeks out, but beyond that, you're probably not going to be selling options. As we reach, or as we approach expiration, the rate of decay continues to accelerate all the way through expiration. The fastest rate of decay is going to be the last week, the last day. But if you're selling options that close to expiration, you might not be getting enough actual dollar premium to make those obligations worth your while. If this spread, for example, was 1 day left till expiration, we'd be selling the 90 and 85s for virtually nothing. So you want to find that sweet spot of how far out can I go to get a premium that's worth it to me, but also stay within that roughly 6-week time frame so that I've got a very healthy, nice rate of decay. And for those of you really looking at decay, you might further consider that when you manage out of the position. You might think, okay, I've gotten some really good decay here. I opened it up at 28 days left. I'm down to 8. I'm down to 12. You can figure this out for yourself and say, I'm going to close it at that point. And I do talk to investors who feel like they've looked at decay long enough where they select their target days to expiration to open, but then they also have somewhat of a target days left till expiration to close the spread, because the premium gets so small when you get close to expiration, it might not be worth holding that position all the way open through expiration.
So Nicholas has a quick follow-up on that, and I'm not sure if I completely understand where he's going with this, but I'll read it out. Following up on the time decay topic, would it make sense to buy the long legs with a shorter time till expiration and then adapt according to the move in that time frame?
Well, let's think about that. So certainly you're not doing an iron condor if you do stagger the expirations like that. If you do shorter expiration on your long legs, and you're going to have to manage that at some point, because if you didn't do anything there, those long legs are going to drop off and you have short call, short put. That's a short strangle. That's not at all the strategy you probably wanted to have. So I think you'd run into some obstacles there. Of course, the short legs are going to decay faster, but they'd also cost a lot less than they would if you were. So you get a nice premium is what I'm saying there. You get a nice healthy premium at the outset because you're selling interior strikes longer dated, buying exterior strikes short dated, but you're going to have to do something to manage that position. That credit is going to probably look too good to be true, because it is. You're going to have to manage that position by either buying protection or buying back those short options at some point to cover the risk. Once those long options drop off, you're going to have to manage the position.
And I'm just going to share my screen here real quickly. And I'm going to take Caterpillar as an example here. I was talking about the standard deviation, and I just wanted to show a couple of things about, how to get to an iron condor strategy using the option trader here, but also on this chart for Caterpillar, right? So you'll see I've got a bit of space to the right hand side here, but if I go into the edit menu and chart parameters, there's a little checkbox here with an estimated price range. If I select that box, I can select 1, 2, or 3 standard deviations, and as you said, one standard deviation being 68.27% of the time, 2 being 95.5%, and 3 being 99.73%. So if I just select a single standard deviation to add to this chart, it's now going to give me a cone, a standard deviation cone, a single standard deviation cone through, and I think I've got this set to something like, okay, that's about November expiration, around the 19th of September. So you can see what a 1 standard deviation move based on the prior 30 days trading for Caterpillar would look like. So that's what I was kind of hinting at. People might look, option traders looking to avoid anything. Somebody who's taking a bet that Caterpillar's not going to move by more than a single standard deviation through November expiration might select something like the 210 strike call to sell, and roughly the 175 strike put to sell in the hope that they just harvest that premium. That's one thing. You'll see I've got Caterpillar up in the order entry. I've got a drop down menu. I don't know where it's disappeared to. I'm just going to select a different stop for a second. I'll come back to Caterpillar. My option chain up here. I'm actually going to select the strategy builder very quickly. And with this button saying option strategy turned on, glance over to the right hand side. There's a drop down next to the word strategies, and here you can select the iron condor. Let's see, we're trading at 194. Maybe I want to put a few more strikes in there before I do this. So I'm going to do, yeah, 2 standard deviations will be good. I'll do that on the tab view. And we're going to look at regular November the 19th expiration. So I've got strikes 155 all the way up to 240. Again, lower right, I'm coming down to look for my iron Condor. And I'm going to click on one leg of the Condor. First of all, what I'm going to do is I'm going to hover over, I'm really looking at the 195, I'm hovering my cursor over the 195 bid strike line there. If I go to my 200, 210 and 190, 185, and I can widen, I should be able to widen that out a little bit too. There we go. Just by moving the cursor here. But I've got I'm using the 190 put side down to 175, and I'm using the 200 strike on the call up to 230. Just use the mouse wheel to bring it in a bit. I'll keep it at $10, and I'm just going to click on that on one of those legs, the 200 strike call, because we'd be selling that, right? And as I do that, you see everything that's left behind there, and it's now gone down into the strategy builder. So the credit on this trade, the net credit, is around $4. It's 434 bid at 376 as a credit. So I'd build one of those, and I'd say maybe I want to do this at 4 credit minus 4. And then if I look at the profile on that, we should be able to get that. I've not done that evenly, right, Ed? What have I done wrong here?
I'd have to look at those strikes again. The stock is 194, is it?
Yeah.
90. Oh, you have 190 versus 185 on the downside. You have 5 strike widths and then 10 strike, it looks like.
So I should have 180 in there. There we go. That'll even it up at around a credit of 5 minus 5. Let's now look at the profile there. We've evened that up a little bit. There we go. And I'll set that to say a 30% move, so we can get a better profile there. So on a single contract there with 4 legs, I'd be getting about what did I say, $500 credit with a maximum loss there of $508 outside the break evens, 185.08 and 204.92. So there, that's using kind of the standard deviation to pick some, to consider the potential for a price move through an expiration date, and then using the strategy builder from the order entry panel to actually bring in and populate an iron Condor. All right, so Ed, I'm going to put the, we'll check for any further questions. I'm going to put you back as the presenter and allow you to share your screen, and you can continue, or we can put up your end slide with your contact details.
Yeah, I will do that. It looks like the questions, I think we knocked them out.
I think we did. I think we did.
Yeah, one I see here about dealing with the trade going against you. Yeah, I didn't quite cover that. If one of your sides is getting threatened, first of all, I'd say when you enter the Iron Condor, you know exactly what your defined potential reward is, what your potential risk is, and you should be comfortable with that up front. So position management, I hope, is taken care of when you initiate the trade. But if one of your sides is getting threatened, you could consider closing out one of the sides, moving the strikes up, actually roll out. The only thing I say about when I talk about rolling, rolling your options is not a clever or magical way of avoiding a loss. What you're generally doing when you roll a position is you are closing something out, potentially at a loss, and opening up a new position in an effort to make that money back. And that's really what you're doing. You're changing the construction, maybe taking a loss, opening up something new, and thinking or anticipating that new position is going to pay you back for a position that has previously experienced a loss. But yeah, when you're threatened on one side or the other, changing the strike prices is one thing you can do, particularly if your opinion on the stock has changed. But remember, the Iron Condor is a neutral range bound. You should expect the stock to move. You should expect one of your sides to be threatened. But what you're anticipating is that when one side gets threatened, then the stock turns around, moves the other way. That's more or less the stock opinion that you have. So you can certainly manage the position, but be comfortable with what you've got when you initiate it.
Ed, you've got your Twitter handle there at @options_edu !. What can people expect by following you on Twitter?
Yeah, so what we do there, and it's actually the team's Twitter, we advertise new things that we're doing. So if we put something up new on our website, maybe a new course, a new podcast, a new video, we'll throw that up there and let people know. Or if I'm speaking at an event, if I'm doing, say, a conference and I'm speaking at a virtual event somewhere, or we're doing one of our OIC webinars that we do every month, we'll let investors or our followers know, which OIC instructor is speaking, what's the topic, here's how you register for one of our events. We just make our followers aware of what we're doing and how they can find us.
Very good. Lots of fantastic options education material at optionseducation.org. Contact Ed at options@theocc.com. You'll find them on the OIC YouTube channel, as well as on Facebook, and as we just mentioned, on Twitter at @options_edu !. And that's not a mouthful, is it? I say that's not a mouthful, your Twitter handle.
Oh no, I didn't quite hear what you said there. No, that's the team Twitter there. So follow us there, follow us on Facebook, watch our YouTube. We got a lot of good stuff there.
Very good. Thanks for joining me today, Ed. We'll see you again in November, and happy travels in between.
Great. You too. Thank you very much. See you next time.
Bye. Bye, everybody.